This is the Legacy Radio Network. You're listening to the Everything Financial Radio Show, and we're chatting today with Mr. Karl Denninger. Karl, prior to the break, you talked about the fact that the level of debt in the system has to be reduced by 50%, by half, in order to reach sustainable levels. What's that going to look like?
It's going to be terribly ugly. The only ways that you can get there are either by doubling GDP while not expanding debt in the system at all, okay? And this, by the way, is what the Republican Party is trying to sell you with Paul Ryan's budget plan. Problem is that throughout post-war history, since 1953 onward, which is what we have statistics for that are reasonably accurate, that has never happened, never, in the post-war history of the United States. So you can throw that idea in the trash can. That's not going to occur. The so-called growth from 1980 forward was all based upon additional debt leverage. So in order to bring those ratios down, you would have to hold debt constant and grow the economy. The only other way you can accomplish this is to default or pay off the debt. In order to get the levels to sustainable levels, you'd have to go from the 350% approximately that we're at today down to about 150 to 175% of economic output of GDP. So you'd have to go from $15 trillion or $53 trillion down to approximately 27, 28, which is about 50%. It's about half. If you look at historically where that credit was and where the share of that credit was, you will find that that essentially means taking the financial credit out of the system entirely, cutting back commercial and industrial by maybe 10 or 15%. That's actually the smallest amount of reduction that has to take place, and taking about half of the current credit in the financial system that exists at household levels out, and then cutting the federal government's share of this by approximately 30 to 40%. So this means running a budget surplus for the next 20 to 30 years at the federal level continuously in order to get the federal budget under control. And the problem with doing this, which nobody is talking about, is that once you get into these exponential cycles, which is where we are now, if the longer you wait to do this, everyone talks about glide paths, okay? The longer you wait to actually run a surplus, the closer you get to it being impossible to ever do, because the amount of cutting that has to actually take place in the budget goes up every single year. So if, last year we had to take out of the budget $1 trillion and change. This year we would have to take out of the budget more than that because we added another $1 trillion worth of debt into the system at the same time. So the problem you run into with these kinds of deficit spirals is that they get completely out of control, and then you have an accident, a monetary accident, like you had to happen over in Greece. The same thing can happen here in the United States. At some point, there is a revolt in the bond market, and the only options at that point are for the Federal Reserve to essentially take down all of the issuance that comes from the federal government, at which point they are simply adding a tax to everyone's earnings, or they allow the bond rates to rise, and the borrowing gets cut off immediately, and then the government has to cut its spending by half literally in an afternoon. The issue is that from a public policy perspective, it doesn't matter which path is taken; they both end up in the same place. When the government engages in deficit spending and the Fed QEs as a means of so-called controlling the curve, which they're doing now, what they're effectively doing is adding a tax to every single person in the economy, not just on their income, but also on all of their saved capital. So each time they do this, if there's $53 trillion in the economy and they put $1 trillion worth of QE into the system, they take 2% of every single financial asset that you own, every dollar you've saved, every piece, your house, your car, your income, and they tax it by 2% because they devalue the currency by that amount. And as this debt goes up, the bang for the buck that they get for each amount of incremental QE goes down because the denominator gets larger.
So essentially, Karl, what you're saying is that the Fed is printing money. In fact, I want to draw your attention. You might have seen the article. I believe it was we're recording this show for play on the 9th, and we're talking on the 4th. And there was an article in the Telegraph that quoted Jim Rogers, who's also been a guest on the radio show, saying that the Federal Reserve in the United States has already started QE3, quantitative easing 3, and the quote from the article said that I know they're going to print more money. They already are. If you look at their balance sheets, you'll see that something is happening. Assets are building up on their balance sheet, and these assets are not coming from the tooth fairy. You've got to love the way Rogers quotes things or puts things. Do you agree that the Fed has engaged in QE3 and Bernanke neglected to mention it at Jackson Hole?
No, but I don't think it matters. The real problem the Fed has right now is, of course, they've done Operation Twist, okay, which theoretically is sterilized because they sell a bond for every bond they buy. The problem with doing it is that what they're doing is trading duration risk. Essentially, they're going out the duration curve, and by doing that, they're adding to the risk the amount of change of notional value they have for each point of move in interest rates. In the financial industry, this is called DV01. And essentially what they're doing is changing that value in the upward direction. So they're leveraging up themselves while pretending not to add any leverage to the system as a whole. They're just doing it in a place where no one sees it. That's a nice game, but at some point it ends. And now the problem that the Fed has with this program is that they're out of short-end bonds that they can sell in order to twist. All right, so they sold their entire stock at the short end, essentially. What they've got left is the long end. There isn't much that they can do with that, and so this is why people are talking about QE3. But when that program begins, what's going to happen is you're going to get a response in commodity markets, of course, because that's what everybody expects will happen. There'll be speculation that will pile on to the actual devaluation itself. And then the bigger issue is essentially what we've got here, just to protect an attempt to protect equity prices, because it's the only game left. It's the hot money flow, so to speak. And we know how hot money works because we've seen it happen in China. Look at where China's stock market is. After the collapse in 2008, 2009, how come their market hasn't recovered? Why hasn't Japan's market recovered? It's been 20 years. And yet if you look at Japan, which is the closest analog to what we've done in the U.S., their nominal GDP is where it was in the 1980s. Not inflation adjusted. They're nominal in not in constant dollars. In nominal yen, their GDP is essentially in the same place where it was 20 years ago. They have accomplished absolutely nothing economically, and since their population has grown, their per capita GDP has actually gone down.
So, Karl, when does the Fed stop printing money? We're in the political season here, and you've made a couple of comments, at least referring to some of the proposals that have been put forth on a cursory basis. When does all this end? When does a politician stand up and say, look, we can't afford Social Security the way it is, we can't afford Medicare the way it is, we've got to raise taxes, we've got to cut spending? Or does the bond market just lay a whooping on the United States? Does it take that long?
History says that the politicians will never voluntarily do this. Okay, this is the history of allegedly representative republics and democracies, is that the people figure out that they can vote themselves a paycheck, and they will do so right up until the point that the market tells them that they can't have it anymore. And so that's the most likely outcome, unfortunately. The problem with our entitlement system is that in order to fix it, in order to actually fix it, we have to fix the medical system, not Medicare and Medicaid. We have to fix the underlying medical system in this country. Somebody has to take approximately, just on the government entitlement side, approximately a $400 billion a year crap sandwich and eat it. Okay? Now, if you tell Granny and Grandpa that they're the ones that are going to have to eat that, you're going to lose your job as a politician. All right? You are going to absolutely get thrown out of office immediately. So that can't be the answer. But what the politicians could do, and won't because of all the bribery that goes on with the campaign contributions and, and the lobbying and everything else, is they could turn to the pharmaceutical industry and the medical and device and drug, and all of the other parts of the medical infrastructure, if you will, the hospitals, the physicians, everybody else, and say, you're going to eat the $400 billion a year. That would sell with Americans. It would also put us on a path that would be sustainable. We could get to where we need to go within the budget. Then you have to do the same thing on the private side, and you do it by pulling them in. And this isn't by imposing price controls. This happens by pulling all the monopoly privileges that the medical industry currently has. So you take those special laws that are out there that only bear upon them and rip them out of the legal books and say, okay, you're exposed to Robinson-Patman, you're exposed to the Sherman Act, the Clayton Act, all the other antitrust laws, you're exposed to all the competitive forces that every other business has to deal with, and prices would collapse. We would see the cost of medical care come down by 80, maybe 90% almost in a day. But if you did not have either the ability to pay, whether it be through credit cards or whatever have you, or you didn't buy insurance, you didn't take any care of yourself, and you got yourself in trouble, it would be very unfortunate, but you would have to rely on charity. And that's where we were in the 1950s and 1960s before all this started.
So, Karl, I think that that's a very interesting idea, and you've shared it before with the listeners here on the Everything Financial Radio Show. When you say that they are going to eat $400 billion, tell us exactly how that might play out in a little bit more detail, and where did the $400 billion number come from?
Well, $400 billion is about half of the federal government's medical spending. Last year it was $820 billion. So if we look at the federal budget and we look at the amount of contraction that we have to take in order to bring it into balance, and then we look at the GDP impact from doing that, because GDP is simply the addition of the different areas of spending, and government's one of them. So if you take that out, GDP will contract, and then, of course, there's follow-through, because if you don't buy a limousine, Barack Obama doesn't buy a new limousine, you don't need the people to build the limousine anymore, right? So there's a follow-through effect in the economy. We take all of that out, and we end up with about a 50% reduction in federal medical spending. The only two ways you can get there are by rationing, which is a whole death panel and, basically the Canadian system that, what Canada does. And the second alternative is you go back to the market, and you allow the market to deal with this, and you stop allowing the medical system to take your cost or someone else's cost and shift it on somebody else, because that's what's going on, and that is why having a baby in a hospital today is an $8,000, $10,000, $15,000, $20,000 proposition. The inflation-adjusted cost of having that child, if you look at what it cost in 1963, which is an interesting date to me because that was the year I was born, and you look at the CPI and take that cost forward, it should cost under $1,000 with a 4-night stay in the hospital. Okay? People don't understand this, but this is real. This is what you're really looking at. There's a surgical center in Oklahoma that only accepts cash. You can take a look at their costs for procedures. It's a fifth of what is charged anywhere else. And that is strictly because we have all of this cost shifting there, and this organization, obviously, if they're just taking cash, can't do that. They can't cost shift on other people. So you pay for your own procedures and nobody else does. Here's the important point. You could come up with $1,000 to have a baby, even if you're poor, by charging it on your credit card, by selling your fancy rims on your car, okay, by hawking your television set if you had to. You could find a way to come up with the money. There's no way you can possibly come up with 10, 15, 20 grand. All right, and that's where the problem is in the system right now.
Karl Denninger, we're going to have to leave it there. We have just a couple seconds. Let the listeners know where to read more about what Karl Denninger writes.
Market-ticker.org.
All right, well, always a pleasure to have you on the show. Thanks for joining us.
Anytime, thank you.
Everything Financial Radio will return after these words. Stay with us.